Good evening, and welcome to another Life After Hours. So welcome on a cold Sydney evening. And tonight we're talking tax returns. So that seems to have brought everybody out in force on this wintry evening in Sydney. So let us know where you're from and we'll crack on. Couple of minutes late start, but sometimes these things happen. So thank you for joining us. And as always, we acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. Before we get into the slides, just a couple of background points. The expression tax return and tax refund get a bit confused, particularly this time of year. So the return is the form that you send to the government, and the refund is the money that they send back to you for overpayments during the year. So many people look forward to their tax refund, but it's really a free loan you've been given to the government for the last year. So in many ways, a small refund is a good refund. But let's come back and look at that. And the other thing that sort of focuses the mind at this time of year is how much tax we pay or don't pay, as the case may be. Australia is sort of a middle taxing power around the world. We're not a particularly high taxing country or a particularly low taxing country. We do, however, rely very heavily on income taxes rather than consumption taxes. This is a positive and a negative. Positive in the sense that, at least for the country as a whole, that it's what they call a progressive tax system. So that is, the more you earn, the more tax you pay as a percentage of your income. Whereas consumption taxes, like the GST or VAT in Europe, tends to be regressive. That is, poor people spend more of their money than rich people, and so they pay a larger share of it. The consequence of all of that, though, is that the top 10% of taxpayers, that's broadly those earning over $150,000 a year, pay 46% of all income taxes. So let that sink in for a minute. The bottom 42% of adults pay zero tax. So it does a very good job of redistributing income. So Australia has a relatively low diversification in incomes, but it does have a high concentration of wealth. So the tax system does a good job, and the tax and transfer system, when you take into account the Centrelink side of the equation, does a good job of redistributing income, but haven't quite cracked the wealth bit, which is probably the third rail of Australian politics. So having said that, let's crack on. Just a bit of housekeeping. The chat is there for your questions. If we don't get to them during the presentation, we will get to them after the end. This is very much about you. I'm not going to talk very long. And then we can talk about what matters to you, and that's the questions you've put in the chat. So let me start my presentation. And we are talking about DIYing your tax return. And for many people, it should be possible with the technology provided in the myGov app to do it yourself. The places where it becomes a little bit more complicated is if you hold ETFs or shares or manage funds in your own name. The income side tends to get pre-filled, although it probably won't get pre-filled until August or September. If you have property, the prep to get the deductions right and to split your maintenance into improvements and maintenance. Once you've got that, the return itself is becoming simpler and simpler. And I guess the trap for young players is really around the capital gains tax, that the myGov system pre-fills the income part of your shares and ETFs and managed funds, but it's not able to work out what your capital gain will be. Now, we'll come back and have a look at this when we get to that section of the tax return, but that's where a tool like ShareSite comes in. or why it can often be better to use a managed portfolio like the Life Sherpa Invest portfolios, which deal with all the heavy lifting on the capital gains tax front. So having said that, let's crack on. And again, just putting this back in the context of the Life Sherpa 9-step freedom factor process, this is step 6, which is the housekeeping bit, which deals with all of this paperwork and housekeeping matters. And they're probably the least sexy part of personal finance, but nonetheless critical to get right. This is a QR code to the Life Sherpa Freedom Factor quiz, which will give you a score across all of the 9 steps and show you how you can improve your finances. So today, again, talking about tax returns, really sort of look at what you need to do to get started, the paper information you need before you get started. It's still early in July. Today is the 29th. So you will have some of this information pre-filled, but many of the managed funds haven't reported yet. And a number of the health funds haven't reported yet. And certainly we're seeing some of the tax reports for income protection insurance dripping in. Clearview sent theirs out today. OnePath is still coming. So probably a tad early to rush off and do your return, but getting close to that time. Generally look to encourage people to use MyTax wherever possible. If you are going to use an agent, and there are good reasons why you would, in particular the ability to delay lodging a return until next year, particularly if you potentially owe money to the tax office, you really want to choose a tax agent or accountant that does a lot of personal returns. And this will usually be a local firm or even one of the big firms like H&R Block or ITP. That if you go to a bigger firm, you're likely to get a junior or someone offshore doing your return, which is sort of counterintuitive, that if you're doing a personal tax return, you don't want to be going to a Big Four accounting firm or even a second-tier firm. You really want to find someone who does lots of personal returns. And because it's really hard to make money in personal tax returns. This is a volume game. And, if you're trying to compete with H&R Block at $150 or whatever it is these days, it's tough to do that if you have the overheads of a big firm. So look for a firm that does lots of personal returns, and you'll find them on your suburban high street. So the first step once you've logged into myGov is to tell it what sort of things you are going to return as income and deductions, which sets out the questions and screens it's going to present you. If you've just got PAYG income, bit of interest and some dividends, really straightforward, just tick the boxes and then move ahead. So the information you're going to need, you're obviously going to need your payment summary from your employer that used to be called a group certificate. They're all generally electronic these days, so it will turn up in your myGov account, and you're looking for the symbol tax ready on it. It gets updated through the year with single touch payroll, so it's usually pretty reliable, and it should be there by the 14th of July. Certainly, I'm seeing lots of them around for our members. You'll then need your bank statement, so you know what your interest is. That will almost certainly be pre-filled, but always check a pre-filled number. They do make mistakes. Banks do report things incorrectly from time to time. Very reliable, but always double check. So having set your account up, you need to then start moving ahead. When you've got shares, you'll need your dividend statement or your distribution statement. So if you've got shares, you'll get a distribution statement, which should show you the dividend that you were paid, plus any franking credits or foreign tax credits that might apply. They will generally pre-fill, but bear in mind that many companies won't be lodging their accounts with ASIC until September. And so you might not expect to get all of that pre-filled. So this is where we look at the distinction between shares and trusts or ETFs or managed funds. Shares are included in your tax return in the year you receive the dividend. And many firms or big companies, CBA, for example, schedules their dividends to be in January and July. So in this year's tax return, you're reporting your July 24 dividend and your January 25 dividend. So it's the year it's paid in that matters. And generally it does pre-fill. Trusts or ETFs or managed funds, on the other hand, are taxed in the year where you are made entitled to the income. Usually, so if you receive a distribution at this time of year, that will usually be for the year just ended. So getting this timing right is important. Where you get a distribution from a trust, it will quite often include items that are not taxable but can change your capital gains cost base. And this was traditionally an issue with real estate investment trusts or REITs, but more and more funds that have adopted the RMET regime now will include parts of your distribution will affect your cost base, usually to increase it. So tracking it is really important. And if you're dollar cost averaging and maybe buying some every month or every quarter, maybe you're participating in the dividend reinvestment plan, all of those will result in quite a few parcels of shares, and each parcel is treated separately for capital gains tax purposes. So you need to track it. So let's say you're going to rebalance and sell some of your holding. You will then need to work out which parcels that you sold. You can generally choose which parcel it is. Most people work on either a last in, first out or first in, first out basis, but you can broadly choose, and that's what will be the cost base to work out your capital gains tax. So your cost base is the price you paid for the unit plus your brokerage, converted at the exchange rate if you're buying overseas on the day. Then you get all these adjustments along the way, and then when you go to sell it, your proceeds are sale price less brokerage converted at the exchange rate of the day. So all of that is quite a bit of paperwork to follow. And so we provide our members with a free ShareSite account, which you can access in Basecamp, or take the easy option and have us do the paperwork for you by investing through LifeSherpa Invest. So dividends, if you get a dividend, you'll usually get some franked dividends, which means the company's paid tax and you're going to get a credit for that. So broadly, company makes $142 in profit, pays 30% tax, leaving with $100 after tax. It then pays you a dividend of $100 and you get a credit for the $42 in tax they paid. And then you pay tax at your marginal rate on the $142. So if you're a 32% taxpayer, then there's very little extra tax to pay. So that can be very attractive. You may also get some credit for foreign tax paid by the company. So if you've got a holding in James Hardie or CSR or BHP, BlueScope, any company with significant foreign operations is likely to come with a foreign tax credit. And they all get entered here. We'll come back to the deductions that go with this later, but this is where you enter all of those. And of course, it's the year in which you receive the dividend. Managed funds, as I said, this is where tracking your capital gains becomes important, but they're included later. So you're going to get a distribution. You'll get a statement from your fund. Some of these spread to many pages, and usually they will include a say, include this number at label 13G or whatever. So just follow the numbers. Very straightforward. It's not necessarily important to understand every word of what each of these components of your dividend distribution looks like. You just copy the number off your AMIT statement and put in the right box. It will be pre-filled, not yet, but it will be. I think I saw the Vanguard timetable and they're talking August, September for most of theirs. Rent now is the other big piece of income that most people will have. And so when you rent out an apartment or a house, you're obviously going to get rent and then you're going to have expenses. So I'm going to put the income side of things here. And this is when it was received by your agent. So it's not particularly relevant when the rental period is. So if someone pays a month's rent on the 14th of July for the period from the 15th of June to the 14th of July, that money goes into your this year's return. So ideally you'll get a statement from your agent and you can broadly copy that across here. And then the next section deals with deductions. So the main deductions most people are going to have, you're going to have some work deductions. You might be working from home, and this year the rate is 70 cents an hour. So for every hour that you work at home, you can claim 70 cents for use of your home, designed to cover off heating, lighting, electricity, cleaning, whatever. That's sort of the fixed occupancy expense. That has no impact on your home exemption from capital gains tax. It's just a recovery of expenses. You might also have some equipment you use, which are likely to be depreciated. So you might have a computer, you might have a printer, scanner, big TV to do video calls, whatever. All of that stuff is likely to be depreciated and go in this section. You might also drive for work. So the cents per kilometre rate this year is 88 cents a kilometre for up to 5,000 kilometres. You need to track where you're doing it, and that's the claim. If you do more, you can look at the actual cost basis where you track your fuel and insurance and rego and work that out. The other thing you're going to get on work deductions is many of you will have income protection insurance. So if you're paying that out of your pocket as opposed to through your super fund, then that's a work deduction. Sometimes a small portion of it is for things that are not directly tax deductible. Some of the policies come with bells and whistles like accommodation benefits and travel for your parents to come and look after you. They're usually not deductible. The portion that relates to income protection is deductible, and that you'll get a statement from your insurance company. As I said, the Clearview ones went out yesterday, I think, and we're slowly seeing them come through. You may also have self-education expenses. So if you're doing a course to improve your current job or meet your CPD requirements, then that will usually be tax deductible. Ones that apply to looking for a better or different job will usually not be tax deductible. Whereas if your employer pays it for you, then they'll get a deduction. So talk to your boss about that one. The deductions for earning your dividend and investment income. If you invested in shares or ETFs, your share site subscription will be tax deductible. Your portfolio management fees, your platform fees, they'll all be tax deductible. Financial advice in relation to setting up a portfolio is not tax deductible, but ongoing advice in relation to your portfolio is. You may also be able to claim the interest on monies borrowed to invest. It needs to be very clear that the money was used for investing. It's not relevant what the loan's secured on. What's relevant is what the money was used for. Real estate, again, your main deductions, your agent's fees, advertising, maintenance, rates, strata fees, all of those things will be normally tax deductible. When it comes to maintenance, though, it can be a bit tricky to differentiate what's repairs and maintenance, which is deductible in the year you pay it, as long as the property is available for rent, from improvements. So if your hot water service fails and the guy comes out and replaces the element, that's repairs and maintenance. If he comes out and replaces the whole cylinder or upgrades it, you might install a heat pump hot water service, that would be an improvement and you'd have to include that in your depreciation. So there's a bit of thinking there. Usually good idea to have a quantity surveyor's report to work out what you're entitled to in terms of building allowance and depreciation. And the one thing you're not allowed to deduct is travel to visit your investment property. So they're sort of the main things that people get a bit hung up on. Now let me see if I can pick up some questions in the chat.